This meeting is being recorded.
Hello and welcome to this IMAP webinar with the title, Are We Heading for a Recession? I'm David McDonald from IMAP and welcome to this. The R word, or recession, is certainly appearing a lot in the news headlines lately, and we're hearing a lot of clients raising the subject as well. Are we headed for a recession in Australia, in the rest of the world? We're going to go through that today, and we thought it was a very timely thing to organise at short notice a webinar on this very topical subject. Now, before I introduce our speakers for the day, I just want to briefly talk about another IMAP event that we have coming up soon. This is a new thing for IMAP, our independent thought conferences. And we have one in Sydney, as you'll see here, on the 6th of September, and we also have one in Melbourne in October. The Independent Thought Conference is a chance for you to hear how teams close to investor portfolios are meeting challenges such as economics, the global geopolitical things going on at the moment, and very volatile markets. The program features some top portfolio managers and consultants, and you see some of them listed here. And in Sydney, we'll be discussing the main asset classes and the outlook for those. So please look on our website, there's more information there, and you'll be getting more detailed emails on that very soon. I'd now like to introduce our speakers for today. Oh, sorry, before I do that, one last thing. You do have a chance to ask questions, and they'll be taken at the end of the presentation with plenty of time for discussion. As you'll see on the slide here, at the bottom of your Zoom screen, there is a little Q&A icon. If you click on that, you can type your question in, and that will come through to the panelists, and we'll deal with those after the presentations. I'll now introduce our speakers for today. First of all, we will have Diana Mousina from AMP. Diana is Senior Economist with AMP. And then we have David Matesic, who is a Portfolio Manager with Atrium Investment Management. So first of all, I'll hand over to Diana to discuss some of the macro. Thank you, Diana.
Great, thank you. Thank you, David. Morning, everyone. Thanks for tuning in. I'm going to share my screen with you. Okay, so hopefully you can see the slide pack that I'm going to run through for about 10 to 15 minutes, just to give you an overview as to how we see the world at AMP and how Australia fits into that view. And then we can talk about some of the implications for asset classes, and David will bring more of those implications through in his bit, and then also in the discussion that we have. So let's first think about where we're starting from at the moment. The PMI data came out on Friday for a lot of the major economies, and it showed a very significant deceleration in activity. PMIs are a really good forward-looking gauge as to how businesses are feeling. They include different components like forward-looking orders, delivery times, input costs, output costs, and they tend to give a pretty good guide to global growth measures and individual country growth as well, but in a very timely way because they come out every month, and they also have a preliminary reading. So the weakness in the PMIs was actually the PMIs went below 50, which means that there was a contraction in activity. In the US, the contraction in activity is occurring in the services sector, which is expected because interest rates have been increased so much over the past few months by the Fed, whereas in Europe, a lot of that contraction is occurring in the manufacturing sector rather than services. Services activity is still holding up quite well in Europe. It probably goes to the point that a lot of people are taking holidays in Europe at the moment, and that's why their mobility numbers are still looking okay. But the manufacturing sector is really being impacted by high inflation, especially around gas prices. So we're due for a slowing in global growth. That is very likely to happen over the second half of this year. And of course, the question is that slowing in global growth going to be bad enough to go into recession? So far, the indicators are that the global economy will probably avoid a recession. but pockets of different countries may experience different things. The US, I think, has the highest chance of going into recession over the next 12 to 18 months' time. Europe probably will flirt around around very, very low growth, but maybe they won't go into recession so far because interest rates haven't risen as much in Europe. The ECB only started raising interest rates last week. So the PMI data is telling us that global activity is likely to slow. When we had the COVID outbreak, we put together these activity indicators for Europe, the US, and Australia, which measure real-time, high-frequency data, things like mobility, job advertisements, traffic data, hotel bookings, restaurant spending, credit card data. And the indicators have been extremely strong over the past few months. They've gotten back to their pre-COVID averages and even above that. But they have started to show some slowing in momentum, especially in Australia. And that's consistent with what you would expect with interest rates going up. I mean, the whole purpose of the central banks raising rates is to get inflation down. The way to get inflation down is to slow down consumer spending and overall growth in the economy. And this deceleration in activity is why markets are getting so worried and spooked that we could be headed for a recession. One forward-looking indicator for recessions is the difference between the 2 and the 10-year bond yield, which is called a yield curve measure. And when you see the 2 and the 10-year yield difference go negative, that can be a sign of a recession, and it has been a sign of recession in the past, because it means that in the longer term, the central banks will have to cut rates from current levels, and that could be a sign that you have over-tightened policy and therefore you need to cut rates. If you look at this chart, the grey bars here show you times when the US went into recession, and about 12 to 18 months before that time, the 2 and the 10-year bond yield curve inverted. So it has been a leading indicator before. It inverted in March when we had the peak period of uncertainty around what was going on between Russia and Ukraine, and that led to the big spike in commodity prices. And it's inverted again recently because markets are getting worried that the central banks are over tightening activity because they have to get inflation down, and that eventually that will lead us into a recession. So, it could be telling us that a recession is coming in the next 12 to 18 months. As I said, I think in the US, there's probably about a 50% chance of one over the next 2 years. I think there's less of a chance in Australia, and we'll come to the reasons when I go through the Australian outlook. But ultimately, we don't think the RBA will be able to hike rates as much as the market's currently pricing in. And because Australia is benefiting from the high commodity price story, which should keep our net export sector alive. But of course, the risks have gone up of a recession because of the hikes in interest rates, but it's not our base case at the moment for Australia. As well, the US is probably in a technical recession right now because the first quarter of GDP was negative, and the second quarter GDP numbers, which come out this week, I think are also likely to show a negative print. Technically, when you get 2 quarters, you would call that a recession, but the way that recessions are classified in the US, their statistics agency, the National Bureau of Economic Research, also take into account things like payroll and income growth, and with the unemployment rate at multi-decade low at 3.6%, and income growth being extremely high over the past 2 years, even if we do get that negative second quarter GDP print this week, I don't think they will classify it as a technical recession. It doesn't meet the other characteristics or the criteria. But I still think that a risk of recession is high into next year once you see further slowing in economic activity in the US. For Australia, we're expecting a slowdown in growth, and actually our forecasts are pretty consistent with what you would probably call a stagflation type of environment. We think GDP growth will slow to about 2.7% year on year to December, and 2.2% year on year to December next year. So that's quite a significant slowing from the current pace of growth. And we also expect that inflation will probably remain quite elevated, between 3 to 4% next year on the trimmed mean or the core measure. So these types of outcomes are still consistent with a stagflation environment, which is not that positive for risk assets or for growth assets. So I do think that there are some there are reasons for caution for equity markets next year. Where will inflation head in Australia? And one of the big differences between what's happening to Australian and US inflation, and why you could say that the US Fed has to tighten rates by more, is because the US labour market, while it hasn't tightened as much as Australia's had, they've had much stronger wages growth. So both in the US and in Australia, the labour markets have both tightened quite a lot. Underutilisation, which is the unemployment rate, and the underemployment rate have fallen to multi-year lows. I mean, in Australia, the underutilisation rate is close to 8%, which we haven't had since before the GFC, and we probably never would have had if COVID didn't happen and we got all the fiscal and monetary stimulus happening together. And in the US, underutilisation is close to a record low. But wages growth in the US is much stronger. On one measure, the Atlanta Fed measure of wages in the US, they're running at over 6% on an annual basis. And that's happening for across the spectrum for different types of jobs, different income quintiles as well. But the labour market is extremely tight. In Australia, we haven't had the same pickup in wages growth, despite a very tight labour market here and the unemployment rate at a 48-year low. So our nominal wages growth, which is the chart on the right, the red line there, is only running at 2.4% on an annual basis. We do expect some pickup. We think wages will get to about 3.5% or 3.25% next year on an annual basis, but still not as high as in the US. There is some inertia in the Australian wage settings in terms of a lot of the state and federal government wages being on, a multi-year kind of arrangement. So, or even on EBAs being on a multi-year kind of arrangement. So you don't get the pass through as quickly. Whereas in the US, the labour market there tends to be more of a shorter term, a private type of contract. And of course, recently we also had the increase in minimum wage in Australia and an increase in minimum award wages. So that should pass through into the wages figures as well. But we don't think that wages growth will get to as high as what they are in the US. So you don't get as much flow through into inflation because wage costs are about 70% of a business's overall cost. So if you have high wages inflation, it does tend to drive higher overall CPI outcomes as well, even though there is quite a circular relationship between inflation and wages. When you have a high inflation environment like we have at the moment, people demand more wage increases, which is exactly what we're seeing, to compensate them for what's happening to inflation. So both inflation and wages drive each other, and there is a very circular relationship between the two. We think that inflation in Australia will probably peak at about 7.5% or so by the end of this year. And in the US, their current, their headline inflation figures are close to about 9% on an annual basis. The chart here on the right looks at the core figures, and on their core numbers, inflation is running at about 6%, whereas for us, we're at about 4% at the moment. And we think we'll probably get to about 5.5% or so. So arguably the US has a worse inflation problem, and that I think is a result of more stimulus fiscally being applied last year compared to Australia. Most of our COVID stimulus was done in 2020 when we had JobKeeper, we had those direct handouts to households, and not as much stimulus was done last year. Our forward-looking indicators of inflation are showing some slowing in price growth, and they have actually been weakening for the past few months. So we put together this pipeline pressure index, the left-hand chart, the black line there. It looks at things like input costs and delivery times that we get from PMIs. It looks at commodity prices, it looks at shipping costs, container costs, Baltic dry, air freight indices. So all of these things have been coming down over the last few months, as you would expect, because a lot of these individual factors that occurred were COVID-driven disruptions that weren't going to last forever. We had a very abnormal increase in consumer demand in 2020 and 2021 at a time when shipping was constrained, the manufacturing and the production process was constrained because of people having to take time off, and as borders were shut, and all of these things are still playing out. So you would expect that this would have not a continuous lifespan, because consumer demand is weakening and services spending is increasing for consumers. So all the things that we were demanding in the past 2 years have when we don't need them anymore. You can only buy a new couch so many times, or you can only buy new clothes so many times as well. So we think a lot of that demand was brought forward, and now we're starting to see more of an increase in services. And of course, interest rates have increased. So consumers' purchasing power has been derailed a little bit. So we think inflation will slow around the world, and commodity prices are also showing signs of a deceleration, apart from gas. And gas is still being heavily impacted by the restrictions around supply, which is related to Ukraine and Russia. And that story is very uncertain, and I can't provide you with any clarity as to when I think that will resolve, because I have no clue. But the other commodities look like they are slowing down a little bit, especially on the agricultural side, which is good news. And with Russia and Ukraine signing a pact around higher grain exports, because that region is a very big player in global grain exports, that should put even more downward pressure on agricultural prices, which is good news. And you want to see falling commodity prices to get inflation down. But we think, obviously, the interest rates are headed higher around the world. The US peak in the Fed funds rate will probably be somewhere at about 3.5% in our view. And we see a big risk that the central banks will actually have to be cutting interest rates in the second half of next year. And we anticipate that the US and the RBA will be cutting rates in the second half of next year. We think that the RBA will be able to hike the cash rate to 2.6%. But not much higher than that, which is still below, it's quite a fair way below market pricing. The market pricing at the moment for the RBA is still close to about 4% in a year's time. We think that that's too high. At a 2.6% cash rate, interest payments that households with a mortgage can make as a share of income will go back to their 2012 to 2020 levels, which is what that right-hand chart shows you, which is still sustainable and manageable. But once you get to a cash rate of about 3%, I think we will see significant stress in the household sector around paying off mortgages, because household debt to income ratios have not gone down in Australia in the past few years, they've gone up. Whereas in a lot of other countries around the world, household debt to income ratios have been coming down, like in the US. And of course, we have the problem where a lot of households fixed at ultra low rates in the past 2 to 3 years. And a lot of those mortgages will roll off this year, and mainly in the second half of next year. I'm included as one of those people who took out a huge mortgage. So it will be a change to household spending. And on the RBA's own estimates, about 38% of households with a mortgage will face an increase in their monthly repayments of 40% or more, which I think is an extremely large amount and poses significant risks to the consumer spending story, and also obviously to home prices. And we think home prices in Australia will fall by about 15 to 20% peak to trough into the second half of next year. And they're already falling quite significantly. They've fallen by about 5% since the first rate hike in Sydney and in Melbourne, and by a little bit less across the other capital cities. But we only started getting rate hikes in May, and we've already seen quite a significant deceleration in activity in the housing market. So I'm just going to leave this slide here, because I'm going to pass over to David now. This just offers our views on major asset classes, but I want to leave this so that we can actually talk about it, and David can offer some of his views. Ultimately, we think that the next few months for shares will still be tough, and that we could see another. We don't think that we've seen the low in share markets yet, because some of the concerns that I've outlined around high inflation hasn't peaked yet, and it's not likely to peak for another few months. And some of the global economic data is weakening even further. So to see a recovery in share markets from here, I think you would need to be confident that inflation has peaked, that the central banks will back off rate hikes, and that you've seen a trough in economic data. And I don't think any of those three criteria have been met yet. So until we see clearer signs of inflation peaking and a trough in economic data, it still will be rough for shares. But on a 6 to 12 month view, once we start to see central banks back off hiking rates as much, we're still optimistic that shares can have a low single-digit positive return, unless we get into a recession around the world, in which case then we're likely to be headed much lower in asset classes. In shares, I meant. Okay, so David, I'm going to hand over to you now.
Yeah. Okay, thank you very much for that, Diana. I have to say, what I found most fascinating from your slides was the fact that Australia's GDP growth has virtually recovered back to its trend, which is absolutely quite extraordinary. But I think before we get into the questions, I thought I'd probably just provide Atrium's current views and positioning and where we see the market, just so we can provide that as a sort of to juxtapose next to AMPs. And so overall, we are actually quite defensively positioned, I would say. Our equity allocations are probably towards the lower end of our range. We see equities facing a number of headwinds, obviously rising interest rates, inflation, the reversal of quantitative easing, or rather seeing quantitative tightening. And so we've, across all of our portfolios, reduced our equity exposure overall. But within that space, we actually maintain a bias towards quality or quality type companies that we think will probably perform much better in this type of environment. Turning to bonds, historically we've been quite underweight bonds, but we've started to put our toe in the water there a little bit. The Australian 10-year briefly touched 4%. So the 10-year nominal bond touched, I think, yeah, just over 4% about a month ago. And so we saw that as a relatively good entry point. But overall, we're still quite, I would say, tentative in terms of allocating there. Credit's an area where we're seeing a lot of opportunities. Credit markets have been sold down quite heavily, and so we're spending a lot of time looking at opportunities there. And then just turning to alternatives, we actually think alternatives are actually extremely well positioned in this environment of elevated volatility and dispersion, and could be a part of clients' portfolios that could continue to do exceptionally well. But yeah, so just turning now to the questions now for Diana. I know you mentioned the chances of a recession in Australia are quite low, but given that immigration is close to zero, and that's historically been a way in which Australia's been able to avoid a technical recession. How do you think Australia will cope with immigration close to zero in terms of the risks of a recession?
Well, that looks to be turning around now. Some of the arrival data is, it's obviously nowhere near back to its pre-COVID levels, but it is starting to pick up. Skilled migration visas that have been awarded are starting to rise as well. The government has decided not to do a catch-up type of program where obviously the last 2 years we haven't had skilled migrants coming in, whereas before we were running a program of about 160,000 new entrants into Australia on a skilled type of or some kind of working visa, but they decided not to play catch-up program to that. So I do think that the migration numbers will start to get closer to their pre-COVID levels. Maybe they won't ever reach the same types of numbers. You could still make an argument that the relationship between China and Australia is strained, and also with the Chinese policy on zero COVID, it might be difficult for travelers and students to come to Australia in that environment. And actually, a lot of the students that arrived, well, generally, a lot of students that come to Australia to study then stay on and work here. So when you don't have the students arriving, then you might not get the flow through back into the workforce. So migration is likely to pick up from here, but probably not back to its pre-COVID levels. Before COVID, Australia's population was running at about 1.6% per annum. So maybe it can go back to about 1% or so, which I think might not necessarily be a bad outcome, because the infrastructure was getting strained from running such a high migration program. And actually, the last 2 years of closed borders, while they've created some issues for specific sectors looking for skills, especially the ones that used a lot of people who were on short-term contracts from overseas or on short-term visas, generally going into the pool of domestic labour has obviously been quite beneficial to the national unemployment rate by bringing it down and bringing that underutilisation rate down. So some improvement in the population, which should also give us a base as to why we might have less recession risks, but probably not back to its pre-COVID levels.
Yeah, no, thank you. Just touching on the terminal cash rate, I think in the presentation you mentioned that you see the terminal cash rate getting to 2.6% by next year. A lot of other banks have just come out and have reassessed that and are now seeing terminal cash rates well above 3. I think the market's currently got a terminal cash rate closer to 4. What would make you change your view about your terminal cash rate and reassess that?
I think if the inflation data was more persistent than we expect, we obviously get the June quarter print on Wednesday this week, and that will finalize our assumption about what will happen at the August meeting. Our current expectations for a 50 basis point hike, but there's a lot of talk about 75. 75 hike seems to be the new fashionable thing for central banks to do. So maybe even more, Canada did 1%. So if the inflation data continues to be more persistent, if the wage numbers pick up faster than expected, as I mentioned in my intro, the wage figures are still pretty low, 2.4% per annum. It's not very high. I think it's kind of difficult to say that we are going to have a wage price spiral. I just don't see how that's likely when you have wages growth at 2.4%. Maybe if it was running at 4 or 5%, but that's not our base case, and we don't think it will get there. So that's why we think a 2.6% terminal cash rate is sustainable for Australia. And also any higher than that, and I do get concerned about the outlook for housing and the serviceability of households being able to manage their mortgage repayments when household debt to income has actually been running at a record high continually in Australia. Australia has a very different housing situation to the US. In the US, people can fix for 30 years, whereas in Australia, the majority of the loan book, people have been on variable rates. In the past 2 to 3 years, about 40 to 50% of people who were taking out a new loan were fixing. So on average, the loan book at the moment has about 40% fixed, 60% variable. And that's quite a large share of people who will face a very big increase to their mortgage costs, two to 3 times when they roll off that fixed rate. So if we had the ability to fix here for 10, 20, 30 years, that could be quite different. But I'm not sure why the mortgage environment is set up like that in Australia. But it's much, much better for consumers in the US, also because they can refinance in between that time if the mortgage rate goes down, even if they fix for 30 years. So the rate hikes in the US at the moment aren't actually impacting someone with a mortgage if they're on a fixed rate. It's only impacting those the marginal borrowers who are just going into the housing market, which is why all the housing indicators in the US have also started to decline. Things like housing permits, building permits, housing starts, and all of those kinds of things.
So just touching on that, we've got a question here. Does the RBA then obviously consider the housing market when setting rates, or do they try and sit above that?
Well, they say that they don't target housing, but it's not part of their actual mandate. I think maybe historically they did tend to have more of a housing put, as in when they saw that prices were falling quite a bit, they might have backed off rate hikes, and because they were worried about the impacts of the wealth effect. And the wealth effect is a real thing. When prices for assets go down, consumer spending tends to go down, consumer savings goes up. People feel less confident. If you were thinking of selling, maybe you're not going to. So you might change your spending behavior because you will have to sell at a later point. in the cycle. So it's definitely a real thing. I think the difference with this current cycle that we're in, the RBA is getting very concerned about inflation and trying to bring it down. And I think that will be more of a factor that goes into their thinking rather than the home price story. They will probably think, even if prices fall by 10 to 20%, well, we've just had a 30% lift in home prices in the past 2 years. What's a 10 or 20% going to do? You know, consumer wealth is still extremely high, even though, you know, even if you bought a house at the beginning of 2020 and you've had a 30% lift, you can't sell a portion of your house to pay for your expenditure, even though your wealth has gone up. So it's more of a, you know, this psychological concept, I think. But I do think that they've changed their point of view on inflation, that they want to get inflation down. That's their main focus. And will they do that at all costs? I mean, maybe, depends how high inflation goes. But I don't think that they'll need to go that high to see inflation go down, because there are natural reasons for why it's going down, which I mentioned in my introduction around commodity prices and the supply story. And also rate hikes, I think, will work here much quicker to slow down consumer spending. Yeah.
So just touching on that, so in Australia, you expect inflation to come down with the rising or with the RBA hiking rates. How about if we turn to the US? Do you think that they can successfully negotiate, you know, a soft landing there, given how elevated inflation is there already?
History is not kind in terms of suggesting that the US can engineer a soft landing in the economy and also keep to get inflation down in a way that doesn't destroy the economy. Usually when the Fed hikes too much or too fast, there normally is quite, you know, a contraction in the economy. So I'm not as confident on that one. The rate hikes in the US will still help to slow down consumer spending, but it won't have as much of a quick impact, I think, on consumers. Some of those reasons that I mentioned around differences in the housing story. I think the inflation numbers in the US are causing consumers to change the types of spending that they're doing. So high inflation in itself is negative for consumer spending. So there is some natural fall in consumer demand when inflation is high. But I think it will be a difficult task for them, and that's why we have a base case of a 50% recession in the US in the next 12 to 18 months. So in that environment, that's why we are not as confident on US equities in the past, in you know, the next 1 to 2 years compared to Australia. We think Australia will do better. I don't know if you have any different views on that, David.
Oh, look, I don't have different views to that. I'm just looking at, we've got another question here saying that inflation's actually been quite low in China and Asia. Why is that? Yep. Why has it been so low there?
It has actually been, inflation has not been much of an impact of an issue in China or Southeast Asia. I think the main reason for that is because they didn't have as much direct consumer handouts given over the course of the pandemic. So in countries like Australia, the US, Europe, the fiscal policy programs were targeted directly to consumers to give them cash back into their pockets. In Europe, to help them with energy costs at the moment. In Australia, JobKeeper. There was a lot of cash flowing around, whereas in China, a lot of the stimulus that was done was more around supporting property investment, infrastructure spending, local bond issuance. It wasn't as directly targeted to consumers. And also because they only really had a lockdown at the beginning of 2020. Yes, they had pockets after that, but in a lot of the developed world, we know we had these long periods of rolling lockdowns, and then you know, Joe Biden wanted to, well, the Trump administration pushed through a very big fiscal package, and then another one was done last year. So I think it's just a story of different types of fiscal policy programs that were done by the different governments.
Do you have any view on the whole sort of argument of, you know, companies onshoring manufacturing in terms of that leading to, you know, maybe structurally higher inflation around the world, given it seems as though trading blocks are starting to form with conflict around the world. You've got the Ukraine-Russia conflict. You've got, China as well, where countries are forming these different trading blocks and things like that. Do you think globalization's potentially going in reverse, and the corollary of that is inflation maybe going to be higher for longer?
Over the next few years, we think we'll get these periods of high inflation like we have at the moment, and then actually next year we see the risk of deflation in some parts, especially in the goods sector, as you get this oversupply of goods from very high production. Now companies got used to high demand from consumers over the past 2 years, and inventories look to be rising quite a lot. And if we're right that consumer demand will slow quite significantly, you could see an overbuild of inventories. There are already signs of that happening, and you could see pockets of deflation. So we will get these periodic spikes up and down, especially over the next 1 to 2 years, because of some of the distortions that the pandemic has created. But we are of the view that the next 2 to 5 years, maybe even longer than that, the inflation environment will be much higher compared to pre-COVID. We don't think that we're going back down to 2% inflation, central banks not being able to get inflation up. For that reason, David, that you said around globalization reaching a peak. And there were already signs of that starting in the past few years. Global trade, in terms of the import and export share of GDP, looked like it was already reaching a peak, and now companies are deciding to either onshore or even near shore, which is just having a manufacturing supply chain somewhere close by. But it will still generally mean that inflation will be higher compared to finding the lowest cost producer in the world. Also, government budgets look to be running at a much higher level than where they were before COVID. That normally tends to be inflationary. The ratio of workers to older population has declined as the populations are aging, and normally that tends to be inflationary as well. So there are some signs that inflation will be higher over the next few years, even though in the short term we might have some of these weird things going on in the data just because of the pandemic distortion, but that won't continue forever.
Yeah. So we've got another question here with regards house prices and rents, and so the question's mentioning that obviously house prices are falling in Australia, but rents are going up quite aggressively. Could that provide sort of more impetus for inflation in Australia remaining elevated for longer and force the RBA's hand? Given I think shelter's about a quarter of the basket.
Rents are going up for new properties. There's quite a big divergence. Rents in the CPI are still pretty low, running well below 3% on an annual basis. So yes, with new rents going up, there will be some increase to CPI rents, but there could just be, first it could just be a catch up from COVID, because rents weren't increased in the past 2 years. Rents were actually cut. So there is a bit of catch up going on here. It will add to inflationary pressures, but if you've signed a rental contract for a few years, and usually people sign them for 1 year in Australia, so we probably just need to wait and see, or wait for the data to show this big increase. But the new asking rents are running at much higher levels compared to the CPI rent. So we do expect some increase in the CPI rents, it just hasn't come through yet. And that's another reason for, yes, why we think core inflation will be 3 to 4% next year, whereas before in the last few years it was running at 2.5% or even 2% or so.
No, thank you. And just another question on the fixed income markets. I think you mentioned that the market's forecasting a cash rate next year of closer to 4%. Why is that? Like, what's the market? Why is the market forecasting a 4? When so many
what
people
does the market know that I don't know?
Yeah.
Well, I mean, the market has been right that that the RBA would have to go much harder than what the consensus was, a year ago. It's probably taking its cues from what's happening in the US, but what I find really interesting is that the US market pricing for the Fed is much lower than, not much lower, but it's lower than for Australia. And they've got a terminal cash rate of, I think, 3.5%, whereas in Australia, it's still stuck at about 4%. The market for those bonds is also not as liquid. So I think that there's some issues there as well. And maybe it's just this expectation that the RBA is an inflation hawk, but I just don't see how a cash rate of 4% here won't create a recession. I think even if we get to a 3.5% cash rate here, that would be a big risk of a recession in Australia, just based on how what the impacts would be for the consumer. Maybe even if it's not a recession, a much further slowing in GDP growth. We currently have 2.2% for next year. Maybe it will slow to 1% if that cash rate gets to 3.5%.
Yeah, no, thank you. Given your view that a recession in the US is, very likely over the next 2 years, and whilst domestically in Australia it's probably not as likely, would you be more positioned? So would you be overweight Aussie equities versus global equities in that type of environment, or is that the house view?
I mean, generally speaking, yes, we are more optimistic on Aussie equities compared to the US. Generally, a high inflation, high bond yield environment is not as positive for tech stocks, which the US has a high weighting on. It's about 40% of the S&P index around tech and consumer discretionary stocks that normally price off what's going on to bond yields. Whereas in Australia, we have a higher exposure to commodities and banks, and the commodity story, I think, will stay quite elevated for some time in terms of we might see some slowing in prices, but overall commodity prices will remain higher than where they've been over the past few years, which should be positive for Australia's national income, but it should also it should be positive for our index. And and obviously in an environment, if the US goes into recession, then we think that Australian shares can outperform.
Yeah, no, great. I've just got another question here on peak inflation in the US. How do you see it peaking this year, or is it a 2023 story?
Sorry, was that for the US?
Yeah, for the US, yeah.
I would have said probably by the end of this year we will see a peak. If our chart on pipeline, those pipeline supply pressures are right, then we should start to see it peaking sometime, but it might still remain quite elevated. I guess that's the issue, right? That it could still remain 6% or 7% on an annual basis, which is obviously still high, but lower than where it is at the moment.
Do you think, just another question on the RBA and their policy, do you think that they'll be heavily influenced by, I would say, the current government? I think we heard a statement from the Prime Minister about them overreaching with interest rates. Do you think maybe that could potentially cause them to not hike as much and in the environment? Do you think political interference?
The RBA hiked in the middle of they started hiking in May before we had the election. So I think that the RBA is, we had the election in March this year, didn't we? No, we had it in May. I'm getting confused now. I don't think that there's anything wrong with the RBA's independence in terms of being sided with the government. It would be in the government's interest to get inflation down as well. And the major driver of any political changes to the RBA would be around what happens to their review. So the RBA is currently, or the government's doing a review on the RBA, and their recommendations will come out in March next year. So they've got a panel of 3 independent experts, economists, and the review started actually not because of what happened to the bond yield thing last year, but it started because the RBA didn't meet its inflation target of 2 to 3% in the past decade, and that was actually what brought out the review. And now what's happened is it's kind of got caught in the RBA. Well, people saying that the RBA lied to people by saying that rates aren't going up until 2024. So it's kind of turned into a bit of that. So there could be some potential changes from that when the recommendations come out in March next year. But I still see the RBA as a very independent institution to the government. And I think that their actions have demonstrated that.
Yeah, okay, thank you. And also turning to the recent significant increase in the minimum wage, and we're also starting to see, a lot of public sector unions, quite vocal in their demands for much higher wages. I don't think we've seen much industrial action yet, but it looks like it. We've seen a little bit. It looks like it's beginning. Do you think Australia's potentially at risk of that wage price spiral?
I think the risks are low. The minimum wage decision impacted about 180,000 people, so it's not that many. The impact to the minimum award wages was more significant. So on my calculations, that decision to raise the minimum wage by 5.2% on an annual basis and minimum award wages by 4.6%, that impacted about 20% of the workforce or so. So yes, it will add to the wage price index measures, but if you look at the other surveys, I just don't see how it's possible that wages will run at 4 to 5 or 6% on an annual basis here. It still looks like there a 3 or 3.5% cash, 3 to 3.5% wage increase will be more average. But that's, I guess, reliant on the assumption that inflation will reach a peak by the end of this year, close to with the trimmed mean running at 5% or 5.5%. So if we're wrong on the inflation outlook and it peaks higher or it peaks later, then maybe wages growth can rise a bit more because people will be demanding higher wages to compensate them for inflation. But it also depends on is the economy strong enough to handle continual high wage increases? And if the business confidence numbers are correct in saying, well, business confidence is starting to decline, and I certainly businesses might not be able to pass on very high wage increases to households.
Yeah, no. Thank you very much, Deanna. And I think that's all for me with regards to questions. So I'll just hand it back to David McDonald.
Thanks, David and Deanna. It's a wonderful discussion there on what's obviously a very topical question. I mean, I guess the good news we heard from Deanna that global growth slowing, but hopefully not a global recession, even though maybe the US is a little higher risk. And even better for us, I suppose, that she thinks Australia is even less likely to face a recession. And that hopefully the RBA is not going to put rates up quite as much as the market's predicting, which is certainly good for all of you that have got mortgages out there like Deanna. And David explained how he would be defensively positioned at the moment at Atrium, given the environment we're in, and there definitely sees headwinds for equities amongst all of that. So some very good discussion there, and just remains for me to thank Deanna Mousina from AMP and David Matesic from Atrium for what's been a really wonderful contribution there. Now, before we leave you, just a reminder again about the IMAP Independent Thought Conference. For those of you in Sydney, this will be a live event in September at the Hilton in Sydney. As I mentioned earlier, it's an opportunity for you to hear from not only some fund managers who are hosting the sessions you can see listed there on the various asset classes, but perhaps more importantly, the portfolio managers running managed accounts and the consultants involved there. There'll be panel sessions on each of the asset classes and discussion on positioning there, and a great chance for you to hear some views in what is obviously a very difficult and volatile environment for markets at the moment. So that's the end of our webinar, and just thank you very much for joining us today. And please, if you want to know more about independent thought, head to the IMAP website. Thank you.
Thanks so much for having us.
Thank you, David.